Nvidia just dropped their latest earnings and it didn't quite go to plan. The stock took a hit of nearly 3% overnight. This is the first time in almost 2 years that this has happened. Could this be the end of their massive 1000% climb, or a sneaky chance for savvy investors to jump in? First, a bit of background. We've been investing in Nvidia since 2016, well before all the AI buzz you're hearing about now. That's thanks to our systematic approach to finding stocks with massive potential. Now, I've got a degree in software engineering, so I've been familiar with Nvidia for many years. But it was our systematic approach that really brought Nvidia's stock potential to light. Unless you're a gamer or a PC enthusiast, you've probably only become familiar with Nvidia in the last couple of years due to all the AI hype. If it weren't for our system, I likely wouldn't have invested back in 2016 either. But here we are, and what a journey it's been. Nvidia has been on quite a trajectory. Let's talk about the 3 major trends that we've invested in with Nvidia since 2016. The first major uptrend was from May 2016 to October 2018, a staggering 640% growth. The second uptrend was from May 2020 to November 2021, an impressive 370% increase. And then the current uptrend is from May 2023 to the present day, a solid 260% gain so far. Now, with this kind of growth, it's no surprise that Nvidia has had to split its stock twice in recent years. First, in July 2021, we saw a 4-for-1 split, and more recently in June 2024, a 10-for-1 split. Why do companies do this? Well, when a company's stock price gets too high compared to similar companies, they often decide to split the stock. This reduces the price per share, making it easier for smaller investors to buy in. Let's look at the numbers. Before the 4-for-1 split in July 2021, Nvidia was trading at $744 per share. Fast forward to the 10-for-1 split in June 2024, and we were looking at a price of over $1,000 per share. From May 2023 to June 2024, the stock climbed from $370 to $1,208 before the split. Currently, we're sitting at around $129 per share. Here's an interesting pattern we've noticed. Nvidia has a habit of pushing beyond $700 after a stock split. We could very well see the same thing happen again once bullish momentum kicks in on Nvidia and it starts setting record highs. This latest earnings report is the first one since the 10-for-1 stock split in June. The market indices have also nearly recovered from the July and August decline and are close to breaking out and setting new record highs. Nvidia itself has bounced back about 40% from the August low. Now, it's not all smooth sailing with Nvidia. We've seen 2 significant corrections, deep declines after every long-term trend. A 57% decline in just 3 months from October to December 2018, and a 69% decline between November 2021 and October 2022. We've also seen periods of 4 to 6 months of consolidation as part of the long-term trends. But this is normal for any stock, and it's where patience becomes crucial. Here's the key takeaway. These deep declines happen after long-term trends. Understanding this cycle is crucial for maximizing your profits and minimizing losses. So how do you actually invest in Nvidia without relying on luck? We use a systematic approach called the 4PS method, or the 4-phase sequence method for short. It's a 2-step process. First, we use a scanner to sift through 20,000 stocks and assets, creating an initial shortlist of somewhere between 200 to 500 stocks that meet our criteria. We then use our bespoke charting tools to manually go through this shortlist and cherry pick the best for our portfolio. Let me break down the 4PS method for you. Phase 1, identify a stock with a proven performance history. A stock that's performed well in the past is likely to do the same again in the future. Phase 2, wait for a prolonged consolidation or base to form. A breakout from consolidation often presents opportunities to profit from strong trends. Phase 3, confirm the breakout from that base. And then phase 4, enter the stock at the start of the next major uptrend. This positions you to profit near the start of the trend and capitalize on big moves. Let's apply the 4PS method to Nvidia's recent history. Phase 1 is from October 2022 to August 2023. We saw a 316% increase. Phase 2 is from August 2023 to December 2023, a period of consolidation. Phase 3, January 2024, the breakout confirmation. And then finally, Phase 4, January 2024 to the present day. We've seen a climb of a 154% increase so far. Now, you might be wondering when to buy if you're not already in Nvidia. Well, we are waiting for a breakout and record highs to start buying up more shares and adding to the positions we have had in our portfolio since the start of last year. Let's talk about risk and exit management. This is crucial. Take small positions of no more than 2% per position per stock and spread your risk across several high probability stocks starting their new Phase 4 uptrend. Remember these mantras: let winners run, cut losers short, and the trend is your friend until the bend at the end. Here's a pro tip: compound winning trends. Add more of a winning stock to your portfolio. By removing the risk on your previous positions, you're not adding any more risk to your portfolio. This is how the best traders and investors do it. And another pro tip: only add to winning positions, never losers. Cap your losses, but keep your profits uncapped. Use the average true range or ATR to calculate your stop loss and trailing stop loss. This ensures it's unique to the volatility of each stock. I like to use an ATR formula, which is the ATR over a number of days and a multiplier. For example, ATR over 5 days multiplied by 4, or ATR over 30 days multiplied by 4. Then use your initial stop loss as your trailing stop loss. You don't want to exit too early if the stock keeps moving up, but you also don't want to give back too much profit when it eventually reverses. Now you know how to enter using the 4PS method, how much to risk, how to compound, and how to exit. The best techniques are simple to learn and execute, but there's a level of sophistication to it that's often overlooked. Okay, so let's talk about why technicals matter more than fundamentals in our approach. We don't rely on fundamentals at all. It's purely technical analysis. Why? Because institutions pay a lot of money to get news early. By the time we hear it, it's old news. Copying institutions is a false economy and very unnecessary. As private investors, we need a different approach, one that's appropriate for us and maximizes our profits. We use technicals to identify the start of a trend and piggyback the ride. The institutions do the hard work of moving the market. We need them, and we need to know where they are to position ourselves accordingly. As private investors, we're actually at a massive advantage. All we need to do is apply patience and wait for the momentum to come in. We have no rules or red tape to deal with, but that's why it's crucial to have a systematic approach, a proven edge, one that's simple and repeatable. Most private investors don't have this, and it's why they blow up. But get it right, and investing in stocks that trend over 12 to 18 months is arguably one of the most lucrative ways to generate wealth from the comfort of your home in just minutes a week and with a good routine. This allows you to get on with your daily commitments while your investments work for you. Remember, patience is your superpower as a private investor. We can wait for the perfect setup and then act decisively. Another tech stock that has been getting plenty of media attention is Palantir, which has recently broken back above $30 a share. Watch this video where I do a direct comparison with Nvidia to see if Palantir is worth its hype.